Picture this: a company that wants to replace your morning commute with a 5-minute flight across the city in an electric aircraft. Sounds like science fiction, right? Except they've got $2 billion in the bank and their first passengers are supposed to board this year.
And the stock is down 63% from its highs. So either the market is telling you something or it's giving you a gift.
Welcome to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we're breaking down Archer Aviation, ticker ACHR, the company betting that electric air taxis are about to go from prototype to reality. Lana Chen is here to tell us whether the numbers back up the dream.
Let's find out.
So Archer Aviation is headquartered in San Jose, California, and they were founded just 8 years ago in 2018. At its core, this is a company building something called the Midnight, an electric vertical takeoff and landing aircraft, or eVTOL. Think of it as a cross between a helicopter and an electric car that seats 4 passengers plus a pilot.
And the business model has two prongs. First, they want to sell these aircraft at roughly $5 million per unit. Second, they plan to operate their own air taxi service. Think Uber for the sky, but on fixed routes between cities and airports.
They've also got a defense angle. The same aircraft technology that moves commuters can potentially move soldiers or supplies. And they've locked in a manufacturing partnership with Stellantis, that's the parent company of Chrysler, Jeep, and Ram, to build up to 650 aircraft per year at their Georgia facility.
The sector context matters here. The global eVTOL market was valued at $14.3 billion at the end of 2025, and it's projected for rapid expansion. This is not a one-company bet. There are multiple serious players racing to get certified and operational.
The competition includes Joby Aviation, which is arguably the furthest along on FAA certification. Then you've got EHang out of China, Beta Technologies, which just IPO'd last November, and Vertical Aerospace out of the UK. But Archer has something notable. They've achieved 100% FAA acceptance of their means of compliance, which is a critical regulatory milestone.
They also have a $500 million pre-order commitment from Oracle, which signals real enterprise demand. And their Stellantis manufacturing partnership gives them a credible path to scale that most competitors don't have.
At the helm is Adam Goldstein, who founded Archer in 2018 and became sole CEO in 2021. He's only been at this for about 5 years as CEO, which makes him relatively young in the role.
Goldstein's background is interesting. Before Archer, he founded Vettery, a SaaS recruitment platform that he sold to Adecco Group for over $100 million, and he'd raised less than $10 million to build it. That's an impressive capital efficiency ratio. Before that, he spent about a decade in investment management.
He's become the public face of the company's ambitious 2026 launch timeline. He's been quoted saying the market is only beginning to understand what Archer can become. Whether that's visionary confidence or promotional optimism depends on your perspective.
All right, let's get into the financials, and I need to set the stage here. Archer is essentially a pre-revenue company. The stock is trading at $5.42 with a market cap of just over $4 billion. The 52-week range is dramatic, a low of 480 and a high of 1462.
So the stock has been cut by more than half from its highs.
Exactly, and here's the thing. There is basically no revenue to speak of. Trailing 12-month revenue came in at $300,000. That's $300,000 with a TH, not million. That was their first ever revenue recognition recorded in Q4 2025.
$300,000 in revenue for a $4 billion company. That ratio is staggering.
Traditional valuation metrics are essentially meaningless here. There's no PE ratio because there are no earnings. There's no meaningful PS ratio because there's no meaningful revenue. The price to book is 4.56, which tells you the market is pricing in significant future value beyond what's on the balance sheet today.
What about the balance sheet itself?
This is where Archer actually looks strong. They've got $1.64 billion in cash and equivalents, boosted by a $650 million equity raise in late 2025. Total debt is only $89 million. So net cash is about $1.55 billion. That's a real war chest.
But the burn rate has to be enormous.
It is. Operating cash flow was negative $106 million in 2025, and free cash flow was negative $487 million on a trailing 12-month basis. The Q1 2026 guidance calls for an adjusted EBITDA loss of $160 to $180 million. At current burn rates, they've got roughly 4 to 5 years of runway, but that assumes no acceleration in spending as they ramp toward commercialization.
So the balance sheet buys them time, but the clock is definitely running.
Right, and EPS came in at negative 26 cents trailing, which is actually not terrible for a pre-revenue aerospace company, but only because they've been relatively disciplined about not blowing through cash faster than necessary. Overall, Archer's financial health is watchful. The liquidity provides a strong foundation, but the massive cash burn and zero meaningful revenue create significant near-term uncertainty around the path to commercialization.
So what are the analysts saying?
The consensus is actually quite bullish. It's a buy rating with 11 analysts covering the stock. 6 have it at buy, 3 at hold, and notably 0 sells. The average price target is $13.20, which implies 144% upside from current levels.
144% upside. That's a massive gap between where the stock trades and where analysts think it should be.
It is, but the range is wide, $9 to $18, which tells you there's significant disagreement about timing and execution. The last earnings report was March 3rd, 2026. Revenue was that $300,000 we mentioned. It missed estimates. But EPS of negative 26 cents actually beat consensus, so they're burning less cash than expected on a per-share basis.
So the street is basically saying, we believe in the destination, we're just not sure about the flight plan.
That's exactly right.
Let me lay out the bull case. Number 1, and this is the big one, the Abu Dhabi commercial launch of the Midnight aircraft is planned for the first half of 2026. If Archer successfully puts paying passengers in the air this year, that's a transformational moment for the entire eVTOL industry.
And it would validate years of development spending.
Number 2, FAA certification progress. While they're only at 15% completion on type certification, they've already achieved 100% acceptance of their means of compliance, which is the roadmap the FAA agreed to for how certification will work. That's a meaningful milestone, even if the full cert is still years away.
The distinction matters. Means of compliance acceptance means the FAA has agreed on what needs to be proven. Type certification is actually proving it.
Number 3, the LA 2028 Olympics. Archer has publicly targeted air taxi services for the Games, with expansion networks planned for Miami, New York, LA, and San Francisco. That's a massive marketing moment and a hard deadline that could accelerate regulatory cooperation. And number 4, the Georgia manufacturing facility with Stellantis. Having a credible path to producing 650 aircraft per year gives Archer a manufacturing moat that most competitors simply can't match.
Now the bear case. First and most critically, Archer's FAA type certification is only 15% complete. Joby Aviation is at 70%. That's a 55 percentage point gap with the company's most direct competitor. In aerospace, certification timelines slip far more often than they accelerate.
That's a significant disadvantage.
Second, the cash burn is substantial. Over $300 million annually in R&D spend alone. Even with $1.6 billion in the bank, multiple future capital raises seem inevitable, which means dilution for existing shareholders.
Dilution is the silent killer in pre-revenue stories.
Third, there's active litigation with Joby Aviation over trade secret theft allegations. Legal overhang creates uncertainty regardless of the merits. And fourth, macroeconomic conditions. When growth stocks get repriced, companies with no revenue and huge valuations get hit hardest. We've already seen that play out with the 63% decline from highs.
Let's compare Archer to the field. We looked at 3 peers, Joby Aviation, Vertical Aerospace, and Beta Technologies.
Joby is the most direct comparable and arguably the leader. They're furthest along on FAA certification at stage 4 of 5, backed by Toyota with over $1 billion committed, and they completed over 850 test flights in 2025. They're planning a Dubai launch in Q3 2026, so they're on a similar commercial timeline to Archer.
Vertical Aerospace is a much smaller company at about 400 million market cap, trading around $4. They're pursuing a different design philosophy focused on regional connectivity rather than urban air taxis.
And Beta Technologies is the interesting new entrant. They IPO'd in November 2025. They're taking a capital-efficient approach focused on cargo and medical logistics rather than passenger service. Different market, potentially less regulatory friction. Their CX300 certification timeline is late 2026.
So in terms of pure passenger eVTOL comparables, it's really Archer versus Joby as the two-horse race in the U.S. market. What are the options traders telling us?
The put-call ratio sits at 0.23, which is very bullish. Call buying is dominating by nearly 4-1. Implied volatility is elevated around the 59th percentile. We're seeing significant call open interest at the $7.50 and $10 strikes, and put interest concentrated at $5 and $4. The read is that options traders are positioning aggressively for a recovery, likely betting on certification milestones or the Abu Dhabi launch as catalysts.
What about insider activity?
Mixed signals here. 2 insider buys versus 7 sells in Q1 2026. The most notable sale was Chief Legal Officer Eric Lentell selling 100,000 shares in the 530 range. There were also RSU conversions by the CAO and CTO, which are routine compensation events rather than conviction signals. The net selling trend is mildly concerning, but not alarming given the compensation structure at pre-revenue companies.
So what should investors be watching most closely?
3 things. First, Abu Dhabi launch execution. If Archer puts passengers in the air in H1 2026 as planned, that's the single biggest near-term catalyst. Any delays would be devastating to sentiment. Second, FAA certification velocity. Watch for incremental progress reports beyond that 15%. Each percentage point matters competitively versus Joby. Third, cash management. The Q1 EBITDA loss guidance of $160 to $180 million sets the benchmark. If burn accelerates beyond that, the dilution timeline moves up.
Lana, bottom line on Archer Aviation.
Archer Aviation is a company at the precipice of either proving that urban air mobility is real or running out of time trying. The stock at $542 is pricing in maximum skepticism, down 63%, with analysts seeing 144% upside. The $1.6 billion cash position buys time, but the 15% FAA certification puts them well behind Joby in the race that matters most. The key metric to watch is simple. Do passengers board a midnight aircraft in 2026? If yes, this reprices dramatically. If no, the cash burn math becomes the entire story.
We'll close with this one. The Wright brothers flew for 12 seconds and changed the world. The question now is whether electric flight can do the same for how we move through cities.
12 seconds. That's all it took to prove that heavier-than-air flight was possible. Archer doesn't need 12 seconds. They need 12 months.
That's going to do it for episode 49 of Charged Alpha, Archer Aviation, ticker ACHR. If you found this breakdown valuable, share it with someone following the eVTOL space. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. Data sourced from public filings, financial databases, and analyst reports. Accuracy is not guaranteed. Information is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall